Welcome back to our show, your show, Let's Talk Stocks. Joining us in studio this morning is Mr. Ryan Strachan. He's a Senior Vice President at GK Capital. Of course, you know we're going to talk about the capital markets, and Ryan is here. Welcome again, Ryan.
My pleasure. Thank you, Neilson.
Ryan, as I said, things are changing.
Yes.
We've seen some interesting happenings over the last couple of months. The UK, the EU, ECB, and now the Fed chopping 50 basis points. The rate cutting cycle has begun.
Absolutely.
And locally, we saw the BOJ cutting what? 15 basis points?
25
basis points.
Yeah,
right?
twice, yeah. Mm-hmm. Yeah, it's a 650 now.
Yeah.
Yeah.
What is happening?
The world is realizing that high interest rates are untenable. Mm-hmm. Businesses cannot grow with that kind of, in that kind of environment. Countries are now starting to see the effects of interest rates on commerce, the economy themselves, on the expectation of recession, potentially on defaults, non-servicing of loans. And as such, they've taken this belated, in my view.
Yes, we see the analysts saying that, especially with the Fed.
Absolutely. And the Fed is, it's unfortunate, the Fed was late in cutting and late in starting. The BOJ, Bank of Jamaica, was early in starting.
Yes.
Maybe a little late in cutting, but it's directly tied to the Fed. And I think perhaps they thought Jamaican economy could tread water for a little bit longer than the US did. And that's exactly what's happened. I think now what we're seeing is, well, okay, the first shoe has dropped. Is that enough, or is there more to follow in the future? I actually think there's more to follow. Because rates are still too high right now, and not yet at the point. One, we haven't felt the effects yet, right? That's 3 to 6 months down the road. And then two, what will happen in 6 months after, when this is concluded? Because it's a repricing, you know, they expect to begin at about 6% going down in Jamaica. Anyway.
In Jamaica.
In the US, it's not going to happen till 4 or 3%, which I think they're at about 4 or 5 now. So it's still some way away, and that is still not going to be enough to offset the losses of some of the persons who bought high, who bought real estate high.
Right, because we saw, even though you saw mortgage rates coming down significantly in the US, I think last week they inched back up.
They did.
And what we're also seeing is the jobs market, which is a part of what the Fed is watching over there, is not yet soaking in these changes.
Correct. And that's now going to tell you about their will and resolve. And if they really have bought into this new normal. Because you see, all right, in the UK and EU, inflation is at 2% or below. You know?
Yes, yes.
It's not there in the US yet.
The EU actually fell to 1.8 something.
Correct,
yes.
correct.
Yes.
Which is no, but that is in parts, I think, because Europe is a softer economy.
And the energy prices which fell off.
Right, than the US. But now, oil is up 10% this week. Granted, that'll be temporary, because once the tension settles. Now, I'll give you another example of how the US has demonstrated that they cannot afford any major disruption. So, we're talking earlier about the ports.
Yes,
right?
yes, the port workers strike.
2 things happened, you know, in quick succession. The first thing was there was a deal cut to delay the protest by 3 months to January 15. This morning I woke up to news that now that's changed, and a deal has been struck for about 60% increase when they had wanted 70 something.
Yeah.
Because again, they were losing about $5 billion a day just from that port strike. But when that filters through the economy, and now coming to holiday season, if that delay was protracted, then I think we'd see those effects. I mean, Q4 in December. So about the report numbers in February, we start to hear about that.
Right,
Combined with high interest rates, what will we be looking at?
Yeah.
So I think their sees how precariously poised they are. The next Fed meeting is in November, as I understand it.
Right, right.
I think a week before the election. I think November 7th. The election is the 11th,
Yes,
I think.
right.
I expect, no matter what J. Paul wants to say, I expect another cut.
Well, yes, the market, as a matter of fact, analysts are pricing between another 25 or even possible another 50.
Yeah, before that.
But certainly at least they expect 2 cuts before the year end.
November and December. And I'm saying, don't put 75 basis points out the door either. That is how much of a nice edge they're on. Because I'm of the view that we may see a recession in the US. I said that 2 weeks ago, a month ago. Some expect a soft landing, which I had believed for a while. But I think too many players bought assets at too high a price or with the expectation of too high a rate of return. With rates falling now, automatically, you're going to see rents should start to follow. It should start to go like that.
Yes, yes, absolutely.
But they're holding the assets in anticipation of a rental return of 8% or whatever.
Yes.
You get 6 or 5, you have a 2 to 3% gap. Now, if you had a mortgage to buy that, then
You're going to be in problems.
somebody's going to hold a bag.
How do portfolio managers begin to reshape their portfolio? When you look especially at the US situation, remember they've had also, different from the port workers strike, they've been hit by Hurricane Helen.
Yeah.
In Florida, all the way up to Nashville, Tennessee, I understand.
North
But
Carolina.
also, the hurricanes would have impacted their oil production.
Yeah. It behooves every portfolio manager to assess, my view, their acquisition price of anything they would have purchased in the last 24 months. Whether that be REITs, properties, where they're heavy in finance, anything that's susceptible to interest rates. And I think they would do well to consider which industries are resilient going forward and make determinations very quickly as far as adjustments. There was just to dovetail with Jamaica for a second, there was dialogue out there that I think the Realtors Board put out some numbers recently in terms of apartment sales lagging and home sales now growing again. There was a time when, as you would know, people were just buying properties to AirBNB and whatever. Just like with BPOs, the larger scale.
Yeah.
Both have softened.
You're correct, because the numbers released this week, earlier this week,
Yeah,
shows that
maybe
construction was down.
Yeah. Now all of this is because it was in pursuit of a return on investment because of persons holding excess cash. Yes. Understandable. Fair. But now it's either one or two things are going to create an expense. Either to retrofit a building you were initially renting to a BPO that's come out, or find a way to offload apartments you bought for Airbnb. Whichever way you're going to have a capital hit.
Yeah.
Right? Now, to what extent you're able to absorb that hit as you spread it across a number of persons, I think will show, one, the need for adjustments in portfolio holdings on individual and collective levels. And then two, what to expect. Because, that capital loss could be the difference between defaulting on a mortgage, which some of the larger firms have done overseas, and riding out the storm at the lower rates.
Yeah.
So, if on this show we've been saying, if we go back in time, I've always said, when deploying capital in that particular season, we had to be careful because the dust had not yet settled and we had not arrived at an equilibrium. And until that equilibrium was hit, which is we're getting there now, that's when you make firm decisions.
Absolutely.
With longer term tenures.
So it still made sense to hold cash even a little longer.
Yeah, and to be measured. I mean, you know, if you're going into tech or whatever, because that hasn't been impacted by the economic storms. I mean, Meta all-time high. Google maybe overpriced with the antitrust thing, but that's still high. Amazon softening a bit, primarily because of, you know, FedEx had some challenges, so they expect to carry over, but then the port issue, and then they said their holiday hiring is expected to be the same as last year, 250,000, which already says, okay, they're not expecting a robust Thanksgiving and Christmas. That's an indicator that I think has missed out of people, you know.
Yes, I hadn't looked at that.
Yeah, so they've already set their expectations, but despite that, those businesses have done well.
Yes, they have.
Regardless of the environment, because of the role they play in the economy. So I really think portfolio managers are going to be assessed. Where NVIDIA, the jury is out.
It still is.
Eh? And people are running the risk of repeating history and going overboard on AI when we're not yet certain where it's going to rest in the grand scheme of things when we settle.
Let's take a look at China.
Yep.
So China has been down in the dumps for a little bit. The property sector has weighed heavily on the economy.
Yeah.
But they've taken some bold steps recently.
Yeah.
And they've cut rates, both medium and long-term rates. They've chopped off the required returns.
Yep.
How will that impact portfolios with exposure to China?
Well, every portfolio is exposed to China. Directly or indirectly. Right? I mean, whichever angle you look at it. If you're holding real estate in a major city, the price appreciation has in part been driven by Chinese buyers. That's the reality.
Yeah.
There's a stock, Louis Vuitton, which had been in the doldrums for a few months.
Yeah.
And the second the Chinese stimulus package was announced,
Shoot up.
it was up about 10%, automatically saying, well, the demand one can expect from China is going to impact that positively. So retail standpoint, absolutely. More dollars in the hands of Chinese consumers means that the whole world feels it positively.
Absolutely.
I think the only concern I have with China, and I've always had it, is the free market and the extent to which the market and its participants are controlled
By
or influenced by the government. And because of that, I have a natural and inherent discount built into any asset that we have direct exposure or even moderate exposure to in China. I mean, at one time, we used to buy Baidu, Tencent, China Mobile, made good money on that. So it's not an area we are unfamiliar with. I've been there, I have an idea of how the landscape is, though it's humongous. So you'll never know everything, you know. So I think it's worth looking at. I think in times past, we've overplayed the influence just because of that free market. I think if you had a more reliable stock market there, accessible, I think then we would really know at that point we're saying.
So we've been chatting with Ryan Strachan, and his very interesting and intriguing discussion about what is happening in capital markets across the world and the decisions portfolio managers are likely to take. Let's continue this discussion. But as we always say here on Let's Talk Stocks, we give you information to make better financial decisions. Come back with us tomorrow morning at 9, another insightful program lined up for you.